Hello, everyone, and welcome back to Your Finance TV. We're recording this on a Monday, which is a little bit different for our Friday musings, but we're lucky enough to have Jay Pulofsky back with us. How are you, Jay?
Good, Scott. Sorry about that change in schedule, but I was traveling on Friday and wasn't really in a place where video would be very useful. So appreciate your flexibility and the flexibility of the audience.
No problem at all, Jay. All right, now this is actually, I'm glad that we're doing this because this is a bit of a special edition. It's the title of your musings is The Manifestation of the Tripolar World. And correct me if I'm wrong, but I don't think you've looked at this for a couple of years, right? It's going this deep into it.
Yep, that's exactly right. It's the first update to the tripolar world thesis in 2 years. And as a quick reminder, kind of back history, the tripolar world, which is in our name, Tripolar World Advisory, TPW, really is a framework that we've developed over the last dozen or so years. So we feel special about it. It's our own IP. It's one of the things that differentiates us versus others is how we look at the world and our framework and the tripolar world, the idea that regional integration in Europe, Asia, and the Americas, thus the tripolar, is the future operating system of the global economy, is something we feel strongly about. And the point, and we've written about it for years, and we actually linked to a couple of our prior pieces in this document. But essentially, this is the first kind of deep dive on the tripolar world that we've done in 2 years. And the reason for doing it is that we just believe, as the title suggests, that the tripolar world is now truly manifesting. And so we've talked for some time post-COVID about the 3 C's of COVID, climate, and conflict driving the tripolar world, right? Everybody's saying, oh, we got to have our own medicine, our own ability to produce pharmaceuticals, right? And then everyone talking about, well, we want to have our own ability to deal with the climate. And then conflict, we need to look at the Ukraine and the US House not passing legislation and Ukraine running out of artillery shells. So those were big drivers. And now, over the last couple of years, we add in the supply chain regionalization, the fiscal policy mix, both in the US Infrastructure Act, CHIPS Act, Inflation Reduction Act, all in the last couple of years, and the manifestation of those in terms of onshoring, semi-fab plants, battery and electric vehicle production. Same in Europe, and we see the same in Asia. And then the thing that really tipped us over to saying, okay, we need to update is artificial intelligence and what that's doing, kind of affecting every company, every country, every consumer, and how the different regions are addressing this. Because there's now AI efforts fully underway in the United States and the Americas, in Europe, and in Asia. So over the last week or two, Alibaba announced it was going to lead a fundraising round for Moonshot AI, which is the leading China AI company, let's call it, I guess. You have the same in Europe with Mistral, which is the French AI leading effort, which is again being financed by multiple different countries and funds within Europe. So AI even, while it's going to touch everyone, ultimately, you're seeing setups in the 3 main regions of the tripolar world. And so you put all that together, and we want to use that to push back against the thesis that says, oh boy, we're deglobalizing, and boy, that's bad because it's going to mean weaker growth, or it's going to mean higher inflation. And when we disagree pretty strongly, I mean, we feel that the structure of a tripolar world where you have regional deepening driving economic activity in Asia, in Europe, and in the Americas is actually a more stable and secure operating system for the global economy than depending on US consumption or China fiscal over the last decade or so. So we're pushing back against this idea that shifting from globalization to what we see as regionalization is a negative. We see it as a positive, and we think it's going to manifest itself even more as we move out of the COVID chaos years, right? And remember, one of our 4 for 24 surprises for 2024 was a return to stability, right? Another one was early cycle. And so we're tying all this work together to say that we're moving into a period of stability. We're moving into a period of better global growth. And as we do that, we're going to see more clearly the manifestation of the tripolar world. And so at TPW Advisory and for our clients, we're already investing on this basis, right? We've already identified 2 years ago Mexico as a huge winner of the reshoring process or the supply chain regionalization process. Late last year, we added Poland as a similar winner in Europe as Europe integrates more fully. We've talked about China increasingly selling more to Southeast Asia than it does to the United States as an example of Asian regionalization. And so we are investing on this, and we believe increasingly going forward that others will invest in this structure as well. And we want to identify our leadership position, our intellectual property ownership of this thesis, and guide people, particularly our clients, on how we can invest in the tripolar world to hopefully outperform our benchmarks.
Okay, well, for the viewers as well, this is just a reminder. This is the monthly piece, and for new viewers, this is how it's usually broken. Well, not usually, it is broken down. Climate, economics, politics, policy, and then Jay wraps it up with his market view as well. So we're going to start with climate here, and it's interesting on this side of it. The EV space has got a little bit of hate coming at it right now. Correct, Jay?
Yeah, no, it certainly is true. And before we get to climate, I just want to pick up on what you said in terms of the monthly. And so the monthlies are our big deep dive documents, obviously once a month. This particular monthly came in at about 6,500 words, 31 different charts and tables from 22 different unique research sources. And so we bring an awful lot together to present the monthly. And in the climate space, we really focused on 2 points, Scott. One was the EVs, as you pointed out, and we really utilized BYD, which is the big China EV producer, which is now the world's #1, the biggest EV manufacturer in the world, producing more vehicles than Tesla. And what was interesting here is the competition in China. And I think we've touched on this before in other discussions. You know, China is a quote unquote communist country, but the competition within China in things like solar or EV or battery production is super intense and super capitalistic, right? And so BYD just introduced electric vehicles that are priced to compete with ICE or internal combustion engine vehicles. And that's a first, right? Historically, EVs have always priced at a premium because the batteries were so expensive and the inputs to the batteries, lithium, et cetera, so expensive. Well, because of all the effort to develop the global EV landscape, you had a situation where lithium prices have crashed, battery prices have come in considerably, and now BYD is taking advantage of that, plus its awesome production capacity to basically go right at ICE cars. And their slogan was, is electricity is cheaper than oil. And I thought that was really a great slogan. And it just shows you, again, the pace of change, which we talk about all the time, very rapid. The hollowing out of the middle, right? There's Tesla and there's BYD in terms of EV. And what's happening is that the middle, particularly where some of the big US traditional manufacturers and the big European traditional auto manufacturers reside, they're getting eaten away. And so BYD is a big threat to that landscape, and they're being very aggressive with their pricing. The other point we'd make real quick is that BYD is also what we call a tripolar world company, as much as we call Tesla one several years ago, when Tesla produced its first cars, not only in the US and not only in China, but also in Germany. So Asia, Europe, and the Americas. BYD is setting up the exact same formula. So they're talking about production platforms in Mexico, in Thailand, and in Hungary. And again, that's our point. Leadership companies are setting up in a tripolar world construct because they need to be in each region to really sell to that consumption base that exists in each region. The other point, the final point on climate, is we talked a fair bit about carbon and how carbon has become a beta play on growth in Europe. And then the absolute last point, sorry, on climate, and very interesting point, is that we have noted just recently a number of hedge funds starting to invest in climate minerals, particularly around copper. So Elliott, which is a very sophisticated investor, hedge fund investor, Apollo, both have developed separate funds to invest in clean energy related mining opportunities. And so we think this is a really interesting area to watch and pay attention to.
Okay, well, let's move on to economics. And listen, you've mentioned a lot of macro surprises this year. Inflation is one that you say is under control. There's a lot of people out there who may disagree with that idea on inflation. Do you really think we have it under control, though, right?
Yes, yeah, no, when we wrote our 2024 outlook last October, we talked about 4 for 24 macro surprises: lower inflation sooner than expected, rising productivity, a return to stability, and early cycle in terms of, are we early cycle in recovery or are we late cycle going into recession? Those were our 4 surprises. We feel all 4 are on track. Clearly, the inflation one is a little tricky in the United States now, though we have to point out that even last week's PCE data, the number is now under 3%, right? You have a 2 handle on PCE over the last 12 months. That's the first time in almost 3 years that we've had that kind of data. You have CPI minus shelter is running at under 2% year on year, 1.9%. So yes, we feel that inflation is under control in the US, similarly in Europe. And so a big driver to that is the productivity side of things. And we're big believers in a productivity supported boom, global economic boom in the next couple of years, as we've talked about ad nauseum for a year and a half, if not more. And so productivity, which is macro surprise number 2, is something we talk at length and demonstrate at length in this monthly, how that is continuing to manifest itself, and remind people that the last time we had a CapEx boom and high growth with low inflation in the United States, the second half of the 1990s, productivity enhancement was a big deal then and a big factor. And we think we're coming into a similar environment now, driven by a number of things. Fully employed workforces tend to drive companies to be productive because labor is expensive, right? You have all the hacks that companies learn to deal with the COVID uncertainty. And we have increasingly, we think, and coming quickly, AI supported productivity enhancements. Not yet visible, not making the argument that AI is already driving productivity. Productivity is quite strong now, running at about 3 to 4% per annum versus 1 to 2% in the 2010 to 2020 period. But when we look forward, when we think about 2025, 2026, 2027, we think AI is going to support that productivity boom as well. And then the last point, so we're focused on two things in economics. One is productivity. The second is a global manufacturing recovery. And we continue to lean on work that Bank of America does. They talk about how their global wave is reminiscent of coming out of recession times. And they note that on a global basis, the percentage of countries with manufacturing PMIs above 50, in other words, in expansion, has gone from 25% in September of 23 to over 40% of countries currently in February of 2024. So we continue to think we're at the very early stages of a global economic manufacturing rebound that tends to average 2 years or so in length, and that reinforces our view that we are in the early phases of a multi-year period of global growth.
Okay, well, let's go on to the ever-popular subject of politics. Now, apparently there's an election in the US this year, and I don't know who's running in it, but I think your opinion that last time we spoke about this seemed a little bit controversial. There's definitely a little bit of feedback that we received from some people. Do you still stand by that theory on Biden?
Yes, we do. And the theory is that Biden is going to win in a landslide, and that former President Trump is actually underperforming his polling. Nikki Haley is bleeding him badly, and within the Republican Party, there's a large number of Republican voters who have said they will not vote for the former president. Importantly, from a structural point of view, he has very little money. The RNC had its worst fundraising year last year in 2023 since 1993. So if you go back, and we have a chart in the monthly, we show year by year the RNC fundraising totals. When you look at the last two pre-election year numbers, right? So 2015 and 2019, I guess, right, to equate to 2023, the numbers are multiples of what the RNC raised in 2023. So that suggests to us that notwithstanding the very strong base of support for former President Trump, it's not translating widely at all, and not translating in the donor community either. And so the last point that supports our thesis is that President Biden is polling 2-1 versus former President Trump amongst independents. So it's really just a basic argument that former President Trump needs much more than just his base to actually win a general election. And there's no sign of him expanding his base. If anything, he's become much more aggressive, much more, his ideas and suggestions and statements are much more volatile, and therefore less and less likely to appeal to independents. And therefore, President Biden has the most money of any Democratic nominee at this point in the cycle, has a booming stock market to his credit, has a record low unemployment streak to his credit, has rising home prices. And while it's not yet translated into powerful polling numbers, we think that as we move forward in the year that, again, we expect to be a solid growth year with continued low inflation, we would expect that President Biden ultimately wins in a landslide. And yes, that's controversial, but we believe in having strong opinions at TPW as long as we can back them up. And we think the data, beyond simply looking at polls, is quite supportive of the thesis that President Biden will win in a landslide.
Okay, well, let's move on to policy. And before we came online, you and I touched on this a little bit. Obviously, we've had a lot of different change on this over the last 12 months. Some people predicting 6 cuts, maybe 7 in 12 months. Here we are now, and people are pulling those calls back to like 4. Could it be less?
Yeah, it's, we feel strongly that the most important point, policy-wise, is that the markets have priced out 3 or 4 rate cuts. So we were at 7. The market had priced in 7 rate cuts in December, and today we're basically at 3. And so 4 rate cuts have been priced out. Bond market has sold off, and yet stocks have been perfectly fine and continue to power higher. And we've written about this. We wrote a piece several weeks ago called Handoff, where we first really talked about this in depth, making the point that we've moved from a rate cut expectation driven stock market driven with multiple expansion. We've now handed off or transitioned to a market that is driven by expectations of solid economic and earnings growth. And again, that's perfectly normal. That's how bull markets tend to go. Stage 1 is, the market's moving before it's visible as to why it's moving, and thus the multiple expands, right? Because the price is going higher while E is kind of flat. We got that in 23. Today, we're having earnings growth of decent level of earnings growth. And for the full year, 2024 and 2025, consensus is double-digit earnings growth in both years. And therefore, the market is starting to now move on earnings. And then you have things like NVIDIA and other tech and semi companies just reporting absolutely massive earnings gains to support that earnings-driven stock market appreciation. And we think that's really like the most important point, because we've had a significant transition handoff as to what's driving the market, and equities were able to make that handoff flawlessly. And that to us suggests the strength of this equity bull market. And the fact that the equity market, bond market, and Fed are all kind of aligned around 3 or 4 rate cuts is a fairly unusual circumstance, certainly over the last couple of years. And again, reinforces our thesis that we're in a return to stability. When you move towards stability, the fact that different actors have a similar view is what stability is, right? People are in agreement. And so I think that is a really important policy point, and it's the one we kind of hammer home in this monthly.
Well, and this all leads into wrapping up with markets, and you touched on NVIDIA there, incredible performance. Even look at the likes of ARM, which I think is up around $1,000 now. SMCI, same sort of thing. So that AI space / tech space is booming. But what does this all mean for the markets, Jay?
Yeah, well, I think it means it's been right to be constructive and optimistic and overweight equities, which has been our view here at TPW Advisory, literally for more than a year and a half, since the summer of 2022. We continue to be constructive. We remain overweight equities and commodities, underweight fixed income, particularly developed market sovereign debt, which we think is pretty unattractive given our growth view. Right, we expect the 10-year Treasury somewhere around 4.5% is a reasonable place for that instrument to be. So when it was under 4 at the turn of the year, unappealing. The fact that it's gone to 4.3 and now somewhere around 4.2, without again any problem in the equity market, is again sign of equity market strength. And so we are really focused in the following space. We want to be overweight the leaders. So we want to be involved in tech, and we are, particularly in the semi space. We want to also be invested in the laggards, because we believe in a powerful bull market, laggards will catch up. And in the US, that's the small cap space. We want to be in cyclicals because we're early cycle. So transports, home builders, industrials, etc. We want to be in the emerging markets and in the commodity space because we think those are big laggards and they're going to perform. And we continue to like Japan, which is broken out into a 35-year new all-time high, as we talked about several weeks ago. Importantly, we want to push back against the idea that the current run-up in AI and semi-related stocks is reflective of a 1999 type bubble environment. We feel strongly that that is just completely incorrect. And there's no, I mean, I was invested in the markets, involved in the markets in 1999. You just added .com to any IPO and it would go up, 2, 3, 400%. Today, NVIDIA is generating earnings growth of 700% year on year. Okay. That's not pets.com. There's nothing like that. And I just point out that the Magnificent Seven today traded a price to growth basis of 1.1 times. That's cheaper than the rest of the S&P and compares to 4 times at the height of the 1999-2000 tech bubble. So we don't see them being in any way, shape, or form comparable. The other point we would want to highlight is in the commodity space, where we're watching really closely things like the copper to gold ratio. We touched earlier in the climate section on the fact that smart money people like Elliott, Apollo, and others are raising money to invest in the mining sector. Okay, so it fits perfectly well. Global economic recovery, mining sector beaten down, commodities beaten down, smart money starting to step into the space. It reminds us a lot of a couple of years ago, the PE firms like KKR and others were talking about Japan as their favorite market in the world. And lo and behold, 2 years later, we're at a new all-time high in Japan equity. I think the fact that the hedge fund space is starting to look at buying mining stocks, and particularly climate-specific mining sectors like copper, and copper to gold is coming close to a breakout. All that lines up really well with our overweight in commodities across energy, copper, miners, precious metals, gold, as well as climate-related subsectors like uranium. We have a pretty big overweight in commodities, and we feel pretty comfortable that that's going to be a really attractive performer for us as we go through the course of the year. So the other 2 points before we finish, one, really important, is the thematic space has seen some real activity, right? So Bitcoin, biotech, the fact that those sectors, and by the way, both of them following on the fintech space, which has had an absolutely rip-roaring first part of the year, the fact that these segments are breaking up and out while interest rates are rising tells us again the power of this market, that it can really allow beaten down thematics to really run even when rates are rising. Suggests we're early innings in those particular vehicles. And then finally, we tie it all together, early cycle, blue sky period of potential growth, with the manufacturing cycle typically lasting 2 years. You have 2024 and 2025 double-digit earnings growth expected for both years. We have a rate cutting cycle led by emerging markets. We have global liquidity plentiful as China and Japan and others continue to provide global liquidity. All that suggests to us that notwithstanding quite a good start to the year and quite a good 2023, that we want to remain positive and constructive and fully invested. And that's not to say that we can't have the 3%, 5% pullback that tend to happen 4 or 5 times a year. Arguably, we're due for one of those, and we may get one at any point. More importantly, though, is what do you do with that? And given our view, as we just laid out, we would be either A, riding through that, or B, using that to add to some of the segments that we've just discussed here today.
Well, Jay, this is a great monthly breakdown, as always. Thank you very much for your time. We'll be talking again to you very, very soon.
It won't even be a week, right? It will be 4 days from today. Can't wait, Scott. Always a pleasure.
Thanks, Jay. And for everyone else out there, Good luck investing.